All right, let's just jump right into this explainer. Today, we're totally demystifying technical analysis for absolute beginners. We're going to reframe the whole thing, not as some casino game of luck or a gamble, but as a disciplined, highly visual study of human psychology. Because honestly, when you look at a stock chart, you are not just staring at random numbers bouncing up and down. You're actually looking at a literal historical record of human fear and greed. So let's break down exactly how to read that record, step by step, and really build up that professional mindset.
To build your confidence up without drowning you in jargon, we've got a super clear roadmap. 1. The technical trading mindset. 2. Reading candlestick charts. 3. Spotting key market patterns. 4. Floors, ceilings, and trends. And finally, 5. Your daily trading routine.
Kicking things off with Section 1, the technical trading mindset.
First things first, we absolutely have to separate fundamental analysis from technical analysis. Fundamental analysis, that's your long-term game. It's where you evaluate a company's financial health, growth, its intrinsic value, basically the underlying cause of a market move. But technical analysis, that is your go-to toolkit for short-term trade entries and exits. It focuses purely on the effect. Technical traders are studying historical data and current price action to catch trend reversals and ride that momentum. And the sweet spot? When you combine the two, you can find those rock-solid companies and perfectly time exactly when to buy and sell them. So the really crucial point here is that market patterns work because they're just visual snapshots of human emotion. Financial analyst John J. Murphy hit the nail on the head when he said, chart analysis is actually a study of human psychology. We are literally studying how buyers and sellers react to events. The charts just give us the pictures of what market participants are doing in real time. And if you can recognize these human reactions, you can start predicting where the market might head next. Why? Because human psychology, fear and greed, pretty much never changes.
Moving right along to Section 2, reading candlestick charts.
Now, a lot of beginners start out looking at basic line charts, the simple ones you see on standard news sites. But here's the thing. Line charts only give you one single data point, which is the closing price. Candlestick charts, on the other hand, are so much better, and they are absolutely mandatory for technical analysis. Why? Because they hand you 5 distinct pieces of data for any given time frame. You get the open, the close, the high of the day, the low of the day, and the overall direction. It's literally giving you the entire story of the daily battle between buyers and sellers. Check out how the color and structure of these candles tell that story. Look at the green or bullish candle on the left. That thick middle part, we call that the body, and it maps the journey from the opening price down at the bottom to the closing price at the top. The green color tells us buyers took control and drove the price up. Now see those thin lines poking out the top and bottom? Those are the wicks. They show you the absolute highest and lowest prices traded during that time. The red, bearish candle on the right shows the exact opposite scenario. The price opened high, but sellers took the wheel and forced the closing price way down.
Which brings us to Section 3, spotting key market patterns.
Let's talk about the incredible importance of those wicks when it comes to spotting market reversals. Over on the left, we've got a hammer candle. This guy usually forms when a stock is in a downtrend. Notice how the hammer's long lower wick shows that sellers initially shoved the price way down, but then buyers bravely stepped right back in, retraced the price upwards, and closed it near the open. It's a huge bullish sign of a potential reversal. Now look at the right. That's its evil twin, the shooting star. This one pops up at the very top of an uptrend. It's got this long upper wick where buyers try to push the price higher, but sellers aggressively slapped it back down. That is your early warning siren that the upward momentum is running out of gas.
Okay, let's practice reading the market's mind with another really common setup. Look at the bullish engulfing pattern on the left. After a downward trend, you'll see a small red candle. But then the very next day, this massive green candle completely swallows or engulfs the previous day's entire trading range. What you're witnessing here is buyers decisively overtaking the sellers. It's a strong hint that the decline might be over. On the flip side, the bearish engulfing pattern on the right happens after an uptrend. A huge red candle completely covers the previous green one. That is a clear, glaring signal that sellers have aggressively seized control.
All right, Section 4, floors, ceilings, and trends.
Let's use a super simple everyday comparison to explain this one. Think of price action like a ball bouncing around inside a room. Support is a price level that basically acts as the floor. Historically, when the price drops down to this floor, buyers think, hey, a discount. They step in and the price bounces right back up. Resistance is the exact opposite. It's the ceiling. When the price rises to the ceiling, sellers historically take over and the price gets pulled back down. Trends? They're simply areas in the market where this bouncing ball is either working its way up a staircase or tumbling down one.
Now, this is where it gets really fun. Notice the magic of the flip playing out here. When a trend breaks through that ceiling of resistance with enough force, an amazing psychological shift happens. That old resistance ceiling magically becomes the new support floor. Think about it. Why does that happen? Because the people who bought near that old ceiling are now desperate to protect their investment, so they put a floor under any new price drops. Once you can visualize these support and resistance levels on a clean chart, you can pinpoint incredibly reliable areas to actually anticipate market turns.
But listen, it's absolutely vital to understand the context of what you're looking at. Depending on your settings, a single candlestick can represent anything from 1 minute of trading all the way up to a full year. Just keep in mind that adjusting your chart to longer time frames, like a daily or weekly chart, really helps you filter out all that chaotic intraday noise. It lets you identify much more reliable long-term market trends. Trust me, you really don't want to be making long-term investment decisions based solely on a choppy 5-minute chart.
And that leads perfectly into Section 5, your daily trading routine.
Here's the good news. You do not need to sit there staring at charts all day to be successful at this. You just need a consistent routine where your actual availability dictates your chart timeframes. If you're super busy and can only check the market once a day, maybe at night, you should strictly be analyzing the daily time frame. If you can check in 2 or 3 times a day, then you might consider the 4-hour time frame. But the absolute most important factor here is consistency. If you randomly bounce around between different time frames, you're going to miss key patterns and totally ruin your trading edge.
To build up that confidence without risking your hard-earned capital right out of the gate, I highly recommend checking out TradingView.com. It's an incredible, free platform where you can practice your daily analysis, draw out your floors and ceilings, and hunt down those hammers and engulfing patterns. Practicing every day on a platform like this is exactly how you learn to manage your emotions while looking at live market charts. You literally train yourself to trust the visual data over your gut feelings.
So, what's the ultimate takeaway from this explainer? Technical analysis is a continuous, deeply fascinating study of human behavior mapped right onto a grid. The floors, the ceilings, the wicks, the bodies, they are all coming together to tell you a real-time story of collective fear and greed. The only question left is, are you ready to stop guessing, stop treating it like a gamble, and start actually reading the story the market is trying to tell you?